Good morning and welcome. It's my absolute pleasure to have you today to talk you through NCC Group's full year results for the year ending 31st of May 2020. So in a minute, I will take you through a brief overview. I will then hand you over to my Chief Financial Officer, Tim Kowalski, who will go through the numbers. And then I'll come back to talk to you a little bit more about our strategy, how we're getting on and where we're going next. And so with no more ado, I think we should get straight into the presentation. The one thing we know from all of the chaos and tumult that COVID-19 has inflicted on the world is that the cyber resilience market is more important than ever. The diagram on the right-hand side is something I've spoken to people about before, and it just highlights the secular growth drivers of the cyber market. Number one, the number of things, the number of connected devices just continues to grow year on year, ignoring the pandemic. That's about smart cities, it is about the Internet of Things, it is about intelligent transport, and that is a trend which is set to continue. In the COVID world, which I'll touch on a bit more in a moment, it's the proliferation of remote working, it's the rapid adoption of cloud technologies. And of course, it's become increasingly apparent that society is more and more dependent on this connected environment to get along. But of course, whilst that's happening, there are more and more bad actors out there seeking to take advantage of the vulnerability and the threat that all those connected devices represent. So the threat just continues to increase. And lastly, but really importantly, the regulatory environment is bounding along trying to catch up. And of course, as regulation increases, so do the consequent costs of compliance failure. And it is these four drivers that has driven the growth of the cyber resilience market and will continue to do so for many, many years to come. So all through the challenges that we've all experienced in the pandemic, cyber resilience is more important. We continue to see online security breaches going up and up. And of course, the shuddering financial impact on so many companies has brought the resilience of their software supply chains and other supply chains right up to the front of mind, which has driven direct benefit into our software resilience division. So in this landscape, I'm delighted to say that NCC Group has shown itself to be a growing and resilient company. I'm here to talk to you with Tim today about a set of results that I'm just thrilled with compared to what we feared might turn out back in March. So in these uncertain times, the recurring high margin, sustainable cash flows generated in particular by our software resilience division, but also increasingly by our managed detection and response offerings in our assurance division are just so important, and we value them so much. We're also privileged to have been chosen to support some of the largest, most important organizations around the world. It represents a quality customer base who are able to pay, and even in difficult times are absolutely aware of the need to protect their reputation. And all of that has us coming through these difficult times in good shape, well positioned to thrive as the leading provider of cyber resilience services. So let's talk a little bit more about the impact of COVID. And there's some good here and there's some which is more challenging. So the good, I think, is fairly obvious. We've all been driven to work remotely to an extent that we would never have dreamed of before. Some companies have accelerated in the space of months digital cloud adoption programs that would otherwise have taken years. And of course, those rapidly implemented programs, the sheer spread now of the way that we're working has massively increased cyber risk. Pulling on the rope in the other direction are some of the logistical challenges, the financial challenges, and indeed the general uncertainty that many parts of our customer base are facing today. And quite understandably, certain segments have chosen to deprioritize cyber risk as they worry about other things. But here at NCC Group, we absolutely believe that this is just building up a well of compliance debt that has to be paid down if those firms are to operate safely for years to come. And as the economy normalizes, we expect to see a continued bow wave of demand as people have to pay down that compliance debt. And so overall, here we are, well placed. We've come through this challenge with a strong balance sheet, well positioned to capitalize on further opportunities as they arrive. I'm delighted to say we haven't had to furlough or make redundant any employees because of COVID. we've deliberately acted to preserve our technical capability and capacity so that we have the ability to meet demand as it springs back. And indeed, we've taken advantage of this time to continue to invest selectively to enhance our proposition and to better serve our customers around the world. And so here we are. Tim will give you a detailed tour through the numbers in just a moment, but I'm very proud to be announcing a set of results here that exceeds what we believed we could do back in March. And in particular, I'll touch on the flat half two to half two performance that was delivered by our software resilience business, heralding a return to sustainable growth in the future. And secondly, an almost 14% growth performance from our managed detection and response business. That is something which has grown nicely over the last few years. We intend to continue growing that strongly over the coming years, and it will form a greater and greater, more and more important part of our cyber resilience offering. We've certainly been hit by COVID-19. We estimate that impact to be around £15 million of sales orders, but we are hugely encouraged by the way we've managed to weather what was a completely unpredictable scenario. And we've done it with a strong balance sheet and preserving our technical capability and capacity. Looking forward, I'll give you a more detailed outlook statement towards the end, but it's fair to say that there is a broader than usual range of outcomes for this coming financial year, which straightforwardly depends on how quickly and when our customers' buying patterns return to normal. But nonetheless, in the medium term, our outlook remains the same as it did previously: double-digit growth in assurance with margin improvement and returning software resilience to sustainable growth. And finally, the way that we have weathered this initial storm gives us confidence. It gives us confidence in our continued profitability and our cash generation. And thanks to that, we're recommending that we continue to pay an unchanged final dividend. So that's all from me on the intro, and I'd like to hand over now to Tim for a canter through the numbers. Tim.
Thank you very much, Adam. Good morning, everybody, and I hope you are all well. I am very pleased today to be presenting these robust financial results for the group in these especially uncertain times. So I'm now going to dig into the figures and take you through the detail. So looking at the financial summary, you can see that we've had continued growth with a strong balance sheet, and we are very well placed to thrive in the future. Our turnover has gone up to 264 million, which is a 5% increase, in spite of the estimated 15 million impact from COVID that you see on the slide. Our gross profit has enhanced by 2.6% to 104 million, and this is on a lower gross margin as we have retained our talent, as Adam had mentioned before. This leads us on to an EBIT of 31.1 million, which is below last year, but is higher than market consensus. When we then look at cash conversion, you can see the real cash strong discipline that we've had going through and is sustained, with 109% cash conversion and the debt dropping £16 million to £4.2 million, which again demonstrates our ability to manage our working capital. Moving on to the P&L, you can see that we have got that increase in growth of revenue, 5.2% in spite of COVID. And our gross profit margin has come down, but that's because of the retention of sales and technical capability to meet the strong demand beyond the current disruption. Then the 31.1 million EBIT is 13% ahead of market consensus. Within this figure, we have an overhead increase of just over £5 million, which I analysed here on the slide. You can see there's a like-for-like increase of overheads of just over £1 million, which is in line with inflation, so it's well controlled. We have a further increase of 3.3 million relating to the SGT systems part, which is going live and will be finished this year. And then we have onerous property cost of 800,000, which used to be put below the line and we've now put it above the line and relates to some onerous leases that we have. In terms of other items of note, you can see that we are implementing IFRS 16 as required, and we've done the conversion within the RNS, and you'll see that as a table for the go-forward position. We also are flagging up that we are going to have no adjustments going forward below the line, so it will all be included within EBIT. And pleasingly, this year we've had no individual significant items. So overall, we're cleaning up the accounting to make it more standard and normal practice. In terms of constant currency, we've had an adverse impact on revenue of just over 1%, and on adjusted EBIT, it's gone down by 1.4%, which represents those higher overheads that we've retained, as Adam mentioned before. Moving on then to assurance. Assurance demonstrates our global approach of managing the portfolio across the world. When we look into the regions, you can see that from a revenue perspective, the UK has increased by 2.9%, but was flat in the second half because it had the most significant impact from COVID-2, from which we're now starting to see some recovery. In North America, it's up by 9.1%. That had a delayed impact from COVID as the pandemic reached there later, and it's also been protected by its large technology sector customers, which have done quite well during this uncertain time. Europe and APAC have increased by 8.5%, and again, it's a reflection and a testament to the resilience of their managed services and their high assurance business that they have within their divisions. Looking at profitability, gross profit went up to 77 million in this area, with a gross margin decline of 0.6 percentage points as we retain those technical and sales staff. Utilisation dropped 7 percentage points from 78 to 71, but as you'll see later from Adam, we put a lot more research days in with that non-utilised client-facing side. And the additional overheads are marketing and support costs to enable the growth of the business. Looking at assurance in more detail now, you can see that, as we mentioned before, we are really looking at the diamond core of our technical consulting, and we are strengthened around that. And the technical security consulting area is the area where we have world-leading capability of breaking into almost any systems. And by doing that, we are protecting our clients. There's been resilient growth here across the geographies, even though there has been mainly felt the COVID impact within this area, and the average order value had pleasingly increased by 17% compared to the previous year. Allied to our technical security consulting, we have managed detection and response, which is where we are predicting and protecting against clients getting future attacks by spotting them before they come in. And in this area, we've really grown strategically, and we're looking at to scale up to get longer duration of contracts, providing larger order values with greater recurring revenues. And sales orders in this area have grown by 24% in the full year to 62 million. So it's becoming a much more important part of our business. Risk management consulting, this has decreased across all geographies and is really a question of simplifying our route to market and tying it more into the diamond core of technical consulting. What's happened in the past is we've tried to compete with the other large consulting areas independently and not really managed to our strengths. So that's where we're returning to that simple route. Products is a small area, has grown a lot, and it's mainly in the Europe and APAC area. Moving on to software resilience. This was formerly known as escrow and really has this recurring high margin revenue and very high cash conversion, which has really been one of the resilient features of our business during the COVID pandemic. That has grown in terms of the individual areas in half two, where the momentum has been flat across the half. So within the UK, it has grown by 2.3%, and this is the largest element of our business, and it underpins and heralds that return to sustainable growth, as Adam mentioned. In North America, we were down by 6%, and that was because we had a lower impact of, we had more of an impact of COVID here, because verification in terms of physical verifying of secure discovery articles has been impacted. And so that has impacted our insolvency work and other work in this area. Europe and APAC is a new market and has grown by 2.7%, which is really good. Renewal rates have stayed at the historically high levels, around 87%, and it was within our expected range. And within profitability, you can see that the increased investments we've made in sales, in operational management, and the new channels that I'll mention has really impacted the profitability in terms of margin, but will be a long-term investment for the future. And we've retained also verification testing, just like we've done in assurance, for that talent for the future demand as well. The other exciting areas within software resilience is that we've now formally launched our partner program to independent software vendors, and we're looking forward to that growing at a good rate. We have co-developed with Microsoft Azure a digital vault, which has enabled global companies to use multi-jurisdictions and put them into virtual vaults in a very simple fashion. And then we've increased our investment in our sales leadership in North America to help turn that round and grow it going forward. Turning to escrow software resilience, in terms of its component parts, its contracts and verifications. Within contract, COVID's had a negligible impact on contracts, and the contract revenue is now stabilized, as been mentioned, which is very pleasing. In verifications, that's continued to grow despite the lower volume in North America, and there's more of it now is under contract than was before, which is a good sign. Escrow as a service, which is escrow within the cloud, is gaining momentum. It's had a strong traction with high-profile client wins. We've had 1.2 million of sales, and it's turned into 500,000 of revenue. And we have some notable wins, including Vodafone, BT, Barclays, and HSBC. So, last but not least, cash. I'm pleased to say that we've really had strong cash discipline, and those working capital techniques that we've used over the last couple of years have been sustained and carried on, and enabled us to reduce our debt by 16 million down to 4.2 million of net debt. This does include the 4.6 million of certain government tax deferral programs. But even so, even without them, we have a cash conversion of 109%. And I was asked if we could maintain this last year, and I said we couldn't, and we have. But I am expecting it to normalise at around 85% over the medium term. I'd just like to highlight as well that we've drawn down fully on our RCF to give us maximum cash flexibility, but this has no impact on our net debt. In terms of free cash flow, net cash flow from operations has increased by 5% to almost 42 million. And in terms of SGT, we have now got a project implementation cost, which has slightly increased to 23 million. And there is an annual increase in system-related expenses, which we expected, of 3.5 million. And you can see within the CapEx line, the CapEx element has gone up this year, as predicted, up to 13.2 million. And we will be finishing all the systems within part of SGT within this calendar year. Now moving to capital allocation, you can see that we paid the dividend in line with policy of almost 30 million in the year. We are recommending an unchanged final dividend of 3.15p because of our balance sheet strength and our robustness and resilience in times of uncertainty. This will also give us a fund for inorganic or organic growth going forward. And with that, I would now like to hand back to Adam, who will give you all the information about our strategy and the outlook. Thank you very much.
Back to me now, and a little chat about our strategy, how we are getting on with the transformation of our firm, and where we are going to go next. Now, the robust set of numbers that Tim has just shown you, all show that, unlike some, poor, tragic businesses out there who are wondering whether their business models are still relevant or whether they have to completely reinvent themselves in this new world in which we're all living. I'm pleased to say that NCC Group, remains on the same course. Our market is more resilient than ever. Our long-term prospects are stronger than ever. And in that context, our destination remains current. We are confident in our trajectory. So just to remind you, our mission remains the same: to make the world safer and more secure. Our vision remains the same. It is to be the leading cybersecurity advisor globally, trusted, sought after for our complete cyber resilience solutions. We want to be the experts in cyber so that our customers can just get on, make money and thrive. We will take away their cyber problems. Over the last couple of years, we've been binding NCC Group together to be one powerful powerhouse. And the way we do that is by resting on our values. We work together across geographies, across technical skill sets, but crucially with our customers as well to solve their problems. We want to be brilliantly creative. That is the spark of brilliance that underpins our distinctive capability. And crucially, we embrace difference. People are welcome in NCC, and indeed it is that difference, the way we use technology differently, which is at the heart of our ability to break into systems, to uncover vulnerabilities, and ultimately to generate value. Our objectives remain the same. For our shareholders, it is double-digit revenue growth and margin improvement for Assurance. It is to return software resilience to sustainable growth, and all the way generating cash in a disciplined, sustainable way. For our customers, we want to use our unique data, our capability, our insights to help them meet their cyber resilience needs so that we can take away their cyber pain and they can get on and thrive. And finally, but crucially, to provide a wonderful environment for our people. In the cyber world where there is a voracious war for talent, we cannot hope to hire everybody and keep them for eternity. Instead, we want to be the hub for cyber talent, a place where people can come to get a great experience, to get some learning, to go off, do something wonderful, hopefully perhaps come back and join us again for a few years later on in their career. And crucially, and something which we have re-energized after the events of the last few months, is creating an inclusive environment where everybody feels safe, can be authentic, and we have a population which is representative of the diverse world in which we live and in which we operate. Now, as we realize that vision in line with our mission, we have our transformation program, Securing Growth Together. You've heard me talk about it for the last 18 months, 2 years or so. And I'm delighted to say that I don't want these results to be all about COVID and the way that we've handled it. I also want to draw your attention to the fact that we have continued to relentlessly transform this business, to release the potential we all believe sits within NCC Group. We have increased our headcount. Our attrition rate has gone down. Our ability to retain technical staff, our key distinctive capability, has gone up. We every year do an employee engagement survey with a company called Best Companies, and we are in the one to watch category, and that's something we look forward to evolving, improving further over time. The way that we are able to stay leading in this ever-changing cyber market is through research. And happily, unlike those firms that have to spend tens or hundreds of millions of dollars on the next product, on the next thing, we are able to fund our talented colleagues to do a little bit of work here, a little bit of work there, researching the next technology, understanding how to break it, what its vulnerabilities are, educating our client base, and in so doing, staying at the forefront of the cyber market. I talked to you earlier about wanting to work together with our clients, providing complete solutions. And one of the ways we look to see if we're succeeding is through our average order value and whether the number of large orders we're capturing is going up. And I'm pleased to say here that the number of orders over £250,000 is up to 144, an increase of 57. So the main takeaway I'd like you to have here is that it's not just about the pandemic, okay? We continue to evolve NCC to make it stronger and to fulfill our potential. However, COVID is a thing. And we realized back in January when it first hit some of our Asia Pac operations that there was something quite powerful coming down the line. And so in February, we stood up a full-blown crisis response team. We went in with two specific objectives. Number one, maintain a strong balance sheet. We didn't want to come out of whatever was ahead like a zombie, just paying down the debt. No, we wanted to come out in a position where we could capture whatever opportunities were ahead of us. And secondly, we deliberately made decisions to hold on to the capacity and capability in sales, in delivery, so that we had the ability to service our clients as demand comes back. And underpinning those two objectives were 5 very clear strategies, and here they are. Number one, anticipate and measure. It wasn't clear how the world was going to evolve, so we built scenarios and, using our new systems, were able to track every day how we were evolving and make decisions accordingly. 2, be resilient. What started off by tracking cases, managing offices, soon transformed into shifting everybody to work remotely, something which happened unbelievably seamlessly, and I'm absolutely delighted and thrilled in the way that happened. 3, straightforwardly, stay profitable. And plans A, B, and C there were to sell. The more that we could stay operational, the more we could continue to deliver value to our customers, the better we would be in control of our own destiny. 4, exploit the downtime. Having taken the decision to hold on to all of our capacity, we knew we would have a little bit of downtime. And so the call went out to everybody to make the firm a little bit stronger every single day by doing something, whether it was research, whether it's development, whether it's building tools, whether it's helping to refine our new systems, whatever it was, exploit the downtime. And finally, prepare for the bounce back. And all that, has left us today well placed to take advantage of future market growth as and when the economy properly normalizes. I'm delighted to say that the investments we've made over the last couple of years enabled us to move seamlessly to remote working in a way which exceeded every expectation I could possibly have had. So what a wonderful underpinning, a strong foundation for us to stand on. Our global approach, which we've increasingly put in over the last couple of years, allowed us to better serve our customers. A lovely example here, an appliance which we internally call Firebase, which came out of some research a few years ago in the UK. It allows us to operate remotely. It allows us to work inside our clients' networks and do vulnerability testing in a way that couldn't be done otherwise. Is something we were able to roll out right across the world. Our client base is more robust today than it's ever been. We have 65 of the Fortune 500, up from 52 last year, and have 89 of the FTSE 350. Our NPS, our Net Promoter Score, is incredibly strong for a business services firm of our type, and you can see some of the logos this year for whom we've done important work. Sales orders up, and indeed underlying recurring revenues and cash flows, which I've highlighted before, from software resilience and increasingly from managed detection and response, are up and have given us more underlying strength. So as we look to the future, we're not finishing. The cyber resilience market is more important than it's ever been. The timing, the speed of the economic bounce back may be a little uncertain, but we are preparing ourselves to be able to deliver more services to more clients in more places around the world in the future. So number one, we're broadening and strengthening our portfolio. A few things I would call out is the new security improvement and remediation services that we are developing and launching. That's all about our ability not just to go into clients and tell them where their vulnerabilities are, but also to help them to become resilient, to become secure. 2, we want to continue to scale up our managed detection and response service line, which is getting such a wonderful reception in the market. And 3, continuing to accelerate the adoption of our escrow as a service cloud resilience proposition. Secondly, we're going to work intensively with our sales teams. We want to optimize our route to market so that we can deliver the full spectrum of what we have to offer to every client, wherever they are in the world. And 3, we want to continue to embed our values and create a wonderful place to work, which attracts the best, the brightest, and continue to be the global hub for cyber talent. And finally, as you're aware, we've invested a lot of money and time in our new systems over the last couple of years. The final ones will be dropping in over the course of this financial year, and we will be refining those to ensure that they deliver improved efficiency, improved user experience, and are the backbone of our operation. And that takes me then to a quick look ahead and summary. So today, we've just about finished our first quarter, and I'm very pleased to say that Q1 trading is ahead of last year, although last year was a fairly soft prior year comparator, and we have had some exceptionally wonderful M&A support engagements that I would say have boosted our assurance business. Our escrow business is flat year on year, so again, holding the line that we first saw drawn in H2 of last financial year. In the short term, the environment remains challenging. It is true to say that parts of our customer base are facing uncertainty, continue to be impacted by financial pressures or logistical issues. We've seen, therefore, some procurement cycles lengthen and become less predictable, which means that there are delays and postponements, in particular in some of the more affected sectors, such as leisure and entertainment. So we've had a good Q1. We look forward with some uncertainty, but nonetheless, we remain resilient, we remain profitable, and we are cash generative. And so overall, we're delighted with the way that we've navigated the first part of the COVID disruption. Our transformation continues with good effect. Our full year performance demonstrates the resilience of our business and means that we are in a great position for future growth. The underlying recurring business from software resilience and also from MDR is an increasingly valued part of NCC Group. In the long term, cyber resilience and our services are more relevant than ever, and I'm delighted that we've come through the first period of COVID with a strong balance sheet and with the capacity that we need to be ready for that growth. And so looking forward, yes, we've had a wonderful Q1, but the range of outcomes this financial year is dependent on how quickly and when our customer buying patterns return to normal. The medium-term outlook, though, remains the same. We will deliver double-digit growth in assurance with margin improvement, and we will return software resilience to sustainable growth. And thanks to the confidence we have gained, managing our way through the first part of COVID-19 and the continued profitability and cash generation we have shown, we're recommending that we continue to pay an unchanged final dividend. And with that, thank you very much. And Tim and I look forward to joining you a little later today for some Q&A. Thank you.
Good morning to everybody. Thank you for joining us today. I look forward to taking some of your questions in just a few moments' time. Now, I'm here with Tim Kowalski, the CFO, and what I thought I would do is just take a few minutes to just reprise some of the headlines of the results. I'm sure most of you will have had an opportunity to read the RNS. The presentation should be available for you to watch and has been for the last hour on our website. But if I draw out some of the main highlights, I think the first thing to say is that I feel that we are absolutely blessed to be working in the cyber resilience market as opposed to many of the other markets at the moment, given the uncertainty that we're all sort of facing. Underneath the cyber market, the four secular drivers, which is the increase in the connected environment, society's dependence on that connected environment, the rise of more and more bad actors, and the relentless growth of legislation are driving, that sort of relentless growth of the cyber resilience market. So despite this short-term impact from the pandemic, and goodness knows how long it's going to last, the one thing we do know is that cyber resilience will be ever more important. And I'm very, very pleased to give you the results that we've been able to present today, which have demonstrated that in this market, despite the challenges that we're all facing, NCC has demonstrated itself to be growing and to be resilient. Now, you will see the thumbprint of COVID on our results. You will see that we've had an estimated £15 million impact on sales orders converting. But to stand before you with a company that has grown during these difficult times, that has delivered a very strong free cash flow of just short of 30 million, I think it's about 29 million free cash flow, to have brought down our net debt to just over £4 million, admittedly with the help of around 4 to 5 million of government deferrals, I think is tremendous. Back in February, when we stood up our COVID management task force, and back in March, when we withdrew our guidance, we weren't quite sure how the next few months were going to pan out. But we went in with a very explicit objective, two, in fact. Number one was to come out with a strong balance sheet. We didn't want to come back out of whatever crisis we were facing on the back foot. We wanted to come out on the front foot with a strong balance sheet and with the firepower to take advantage of opportunities as and when they appear. And the second thing is, having spent so much effort, creating a pool of high talent in cyber. And as we all know, those skills are scarce and hard to come by. Having seen our retention rates go up over the last couple of years, what we really didn't want to do was spoil that. And so we made some very deliberate, conscious decisions to hold on to our capability and our capacity. So even though we felt the impact from COVID, we did not furlough any colleagues. We did not make any redundancies because of COVID-19. And so today, the results you've had a chance to look at, our revenue is up, our profits are down, significantly because of those. Well, profits are down slightly, but the significant part of that cause is our decisions to hold on to our capability and capacity. However, I really want you to take away from our results today that we have not been defined by COVID. We're still operating in a good market. Our destination, our ambition remains current. We have a strategy and we are executing it relentlessly. So you will also see that we have done more research. Our average order value has increased. We are delighted by the growth of our managed detection and response business line in assurance, which underpins our business with more and more recurring revenues. And that is a trend that we are very focused on continuing over the next years to come. Our escrow business, which has declined over the last few years, was flat, half two to half two, which is a good result and something we're very, very pleased at. As you know, returning escrow to sustainable growth is one of our key objectives, and I'm delighted to see the progress that we've made on that. Looking forward, we're taking this time. We don't know how long uncertainty will plague our client base, how long people will feel financial and logistical pressures, but what we are absolutely determined to do is come out of this in better shape than we went in. So we will come out of this with a strong balance sheet. We are continuing to invest selectively to broaden our proposition so that we can better serve customers wherever they are across the world. And then, just one final word on outlook. I'm very pleased to say that in the first 3 months of the year, we feel slightly on the front foot, compared to what was a very weak comparative period last year. Our Q1 is running a little ahead, although we are flagging, but that is because of some, rather lumpy and excellent, M&A support work that came in towards the end of last financial year, which has spilled over into Q1. The run rate underneath, we are seeing clients lengthen their procurement cycles. We are seeing them become a little bit more predictable, and straightforwardly, how we do this full year will depend on how quickly and when our clients' buying cycles normalize. So look, I think that's a quick canter over the main features that you would have heard me speak of in the presentation, and I'll be delighted to take any questions that you might have.
Ladies and gentlemen, if you would like to ask a question, you may do so by pressing star followed by 1 on your telephone keypad. If you change your mind, please press star followed by 2. When preparing to ask your question, please ensure you are unmuted locally. If you are joining us via the web, please press the Request to Speak flag icon. There will be a brief pause as questions are registered. We have a question from Tintin Stormont of Numis Securities. Your line is now open. Please go ahead.
Hi, good morning, guys. One question on escrow and one question on the assurance side of the business. On the escrow side, could you just talk a little bit more about the pipeline and what you're seeing there, maybe differentiating between the EAS offering and the sort of kind of the more standard one? What you're seeing in terms of that, and in terms of kind of going forward, sort of how nervous are you in terms of volumes there, if volumes of kind of new license sales towards the back end of the year start to come down, if there are pressures on CapEx budget? Just trying to get a sense of kind of the build-up of the pipeline there. And secondly, on the assurance side, if it's possible to perhaps describe some of the kind of the trend to some extent month on month as you went through the period. You rightly pointed out that Q1 last year was obviously a weak period, followed by a really good bounce in Q2. In terms of kind of the orders and the pipeline that you're seeing there, does it feel like a better environment going into that Q2 versus, say, kind of the last few months? Just trying to get a sense of, if you're seeing that. I take it that obviously we don't have the visibility in terms of corporate budgets as sort of kind of the year goes on. But in terms of what you could see at the moment, is that sort of kind of improvement kind of happening?
Yeah, absolutely, no problem. Hi, good morning, Tim. Thanks for joining. So look, I'll have a pop at those, and Tim, if you have anything to add on top, then please do shout. So let's take those in turn. First of all, if we look at escrow, we look at our pipeline. We are seeing nothing untoward at the moment. I think it's fair to say, Tim, that we were hoping to have tilted back to a bit of growth in H2 last year. So, delivering a flat H2 is probably the minimum expectation, but we were impacted by, for example, not being able to get into clients' offices and do some verification work, in particular some secure discovery work in the States, which held us down a little bit. But at the moment, there's nothing untoward in our pipeline. We are naturally cautious, like everybody is, as people go through their budgets line by line, looking for every cost saving they can possibly find. The sort of work we're doing, I'm sure it's the sort of work that other people are doing as well. So that's all fine. But with our EAS, I mean, we had, I think it was £1.2 million of orders last financial year. So it's a number that we're thrilled with, but in the context of the available market, it's just not a very big number. So even though there, I'm sure, will be greater nervousness about license sales over the next 6 to 9 months, I think our scope for market penetration is just so significant that it shouldn't hold us back from continual growth in escrow. What we're really looking at is, it's just your procurement cycles and the speed of people making decisions, which seems to be just a little bit slower. But so far, as I think I've highlighted in the presentation, escrow is flat year on year. So again, we're looking forward into the mist, but there's nothing that causes us undue concern at this point. Now, assurance, coming to that question, trying to give you a flavour of the month-on-month piece. It's let me see if I can do this. I mean, first of all, we definitely saw a wave of impact from coronavirus across the world. So it hit our smaller Asia-Pac operations first, and then it washed across Europe, and I think North America was last in, and indeed it was last out. As we roll through this year, Q1 has, I suppose, exceeded our expectations, is the simplest way of putting it. Visibility hasn't been good for some time now, but we have had a fabulous team of people, both at the management level, both at the sales level, both in our delivery teams who are actively supporting our sales colleagues, trying to get scoping done quickly, come up with the best possible solution, get things converted. So it's been an absolutely heroic team effort, and that, as I think it was inelegantly described by one of my colleagues, knife fight in a phone box, has kept us, moving forward in a way that we're pleased with, boosted by the exceptional M&A work that we talked about. Now, last year, at the half-year point, you'll remember I stood up and said Q1 was really, really weak, but we had just this fantastic bow wave of orders that we could see running in the door. So we had great confidence over Q2, and Q2 indeed turned out to be absolutely wonderful. We're not quite in that place. We've had a Q1 that's put us on the front foot, which is good news. We don't have that bow wave of orders coming through, which guarantees a Q2. So what we're doing is we're moving forward into the fog, trusting ourselves to be able to execute in the way that we have so far. But there's more uncertainty than we had in the same month last year.
That's really helpful. Thank you.
Thanks, Tintin.
Our next question is from Sanjay Jha of Panmure. Your line is now open. Please go ahead.
Hello, can you hear me?
Good morning, Sanjay. Yes, we can.
Yeah, excellent. I just wanted to follow up on the escrow. Can you explain to me what happens if companies, let's say, go out of business or they are in financial pressures, what happens to your contract on the escrow? I just wanted to understand the dynamics, and if you could explain to me.
Yes, certainly. I mean, hopefully I'm answering rather the correct question here. If I'm not, come back and tell me. So the escrow contracts that we write, are specifically release the source code to the person who has bought it under certain conditions. And one of those conditions is typically if the vendor goes bankrupt. So when that falls into financial difficulty, we would release the source code to the licensor, whether that's a bank or a transport company or whatever else. Does that answer your question, or have I missed?
Okay, so basically there's no recourse to you. There's no kind of liability to NCC, or there's nothing to be done. I'm just trying to say, is there kind of a follow-up business for you, or is that the end of it? You just release the source code?
Oh, so I mean, on the whole, we release the source code, but there have been some very good examples about where large multinationals have bought software from much smaller businesses, and they have gone out of business. And of course, they then face the challenge of standing up and continuing their operations. Of course, getting hold of the source code is an important part in that overall answer, but it's not the whole answer. So we do have some lovely case studies of where we've secured, six-figure sums helping people to stand up continuing operations. So yes, those follow-on opportunities do exist, but I wouldn't highlight it as part of our core business.
Okay. Can I just keep on escrow, if I may? I know you had sort of increased the bonus structures or incentive structure for your staff, depending on contract and verification. How has that panned out? So that sort of, have you seen more effort to bring get verification work? I know it's been difficult under COVID-19.
Yeah, I mean, I think it's difficult to point to a cause and effect. And I will also credit the management team in escrow, which has been significantly strengthened over the last 12 months with pulling a whole raft of levers to take our proposition to market more effectively. So I think they've had days which have been purely focused on cloud sales, for example. But on the whole, we have a team now which is selling a blend of our on-prem solution, it's selling our cloud solution, it sells a blend of contracts, it sells a blend of verification. And you're absolutely right. I think about 12 months ago, we did change and tweak our commission structures just to make everybody realize how important it was for us to continue to secure that solid base of contracts. But, we also recognize that every verification sale we make is about 10 times the revenue of the contract. So I think, if my memory serves me correct, Sanjay, I think we sort of tweaked and refined that through the year, and I couldn't honestly tell you exactly where that stands today. But what I can tell you is that everybody in escrow, from the top management down, is absolutely focused on maintaining that contract base.
And Adam, if I could just add, in verifications, that's the element that is more discretionary. So we expect it to be impacted more by COVID. And as you can see in America, it was, but overall, verifications grew by 1.7% year on year. So we're pleasantly surprised by that.
Okay. Thank you very much.
Thanks, Sanjay.
Our next question is from Ken Rumpf of Jefferies. Your line is now open. Please go ahead.
Hello. Excuse me. Hello, gentlemen. 3 questions, if I could. One is, you mentioned that there was some one-off or lumpy, I don't know if one-off's the right word, sort of contracts benefiting the first quarter. Can you sort of quantify that? Is there a sense of the sort of underlying trend in the first quarter? Secondly, just on cash, you mentioned obviously that, that the deferred tax that the government introduced sort of saved you some money. Basically, just what kind of unusual items or reversals should we expect in the current year? Is the working capital situation normal? Is there anything other than tax we should think about? And finally, just perhaps given the weakness of the dollar generally, a comment on kind of FX exposures sort of as a guideline, depending how things pan out for the rest of the year. Thank you.
Thanks, Ken. Lovely. Well, look, Tim, if I just say a little bit about the first one and then hand over to you, if I may, for a far more educated answer than I could possibly give. So I think it's always tricky, Ken, when pointing at some lumpy or sort of irregular work, because I think exceptions happen every year, if that makes sense, both upwards and downwards. But the key message that we wanted to get across is to say we've had a good first 3 months. We're sort of on the front foot rather than on the back foot, which is great. And I hope that kind of confidence comes through in our trading statements. But, it's absolutely essential that I point out that the trading has been boosted and that the underlying run rate is running, below the level we saw, of the pandemic. So stripping out precisely, I think is tough. Tim may have some better granularity on that, but I wanted to get across the qualitative piece in particular. But Tim, if you've got anything on that and then the others, that would be very helpful.
Yeah, I think we're estimating the one-off impact of this bluebird of M&A, and don't get us wrong, Ken, we do always have bluebirds coming in, is up to a couple of £1 million in the first quarter. So that's that, but bluebirds do come in lots of years. In terms of your cash question, the deferral of cash with government schemes, and I'm going to split it because it is important. We have a 4.6 million government tax deferral, which is split by 3.4 million of indirect taxes. So that's, if you like, above the line and affects cash conversion. And then we have 1.2 million of direct taxes or corporation tax equivalents across the world that gets you back and goes on the tax line. And that's why we've made the distinction, and that reduces net debt. All of those taxes have now been paid back, and so I don't perceive there to be any problem in terms of going forward or unusual working capital movements, other than the fact that we're in COVID-19 and generally, as you'd appreciate, cash is king and people are conserving it. But we are, the message to our credit control team is we shout the loudest and get paid, hopefully, amongst one of the first, as you can see in our cash performance. In terms of tax rates at 23.5%. We think that effective rate is about right because we've got the blend of the US tax rates, which are higher, federal and state versus the UK. So unless either of those, they're the two main tax movers in there, unless one of those move, it should be around the same. We have an offset of R&D tax credit, but that's a lot lower this year, and we've made a provision there. In terms of the dollar weakness, we don't tend to have a FX exposure because we are self-hedging, if you like, because roughly our US and UK operations are roughly the same size. And so, in fact, what happens is it tends to net off and not give us a big exposure. Obviously, it moves one way or the other. You see it on the constant currency issue, but it doesn't really affect us materially because of that self-hedging naturally within the company.
So you mean there's no sort of transaction effect, it's purely translation, that, whatever the value of the dollar turnover is, yeah. Okay. If I may just a quick follow-up. You've flagged that you're going to stop reporting adjusted numbers, and indeed we had no more exceptionals or ISIs in the current year for the first time in a long time. So pulling on the hair shirt there, Tim, do you want to comment a little bit about why you're choosing to do that? I think probably plenty of people would still look at things like amortization of acquired intangibles and share-based payments as a little bit different and not cash items and so on.
Okay, so overall, what we're trying to do is obviously clean up our accounts to make them what I would call more normalised and best practice. And if you look at the best companies across the world, they tend to have nothing below the line. So that's the overarching objective, is to become a normal, good best practice company. The FRC also would like companies to clean up their act and have nothing below the line. So it's good practice in terms of the best practice from the institutes as well. If you look at the ISIs, we're not saying we can never have any ISIs again. We're just saying this year we don't have any. And the last time we looked, we think it's at least 10 years since that's occurred. If there was some huge event that happened in the future, there could be an ISI again. So we're never saying never, but what we're saying is that this year we have none, and we'll try our best not to have any, unless it's an exceptional circumstances, truly. In terms of adjusting items, it's just along those lines. We want to really adjust and put those things above the line again, and just say, look, the EBIT is the EBIT, and there's nothing else to move around. We will still clearly identify those elements of share-based payments and amortization of acquired intangibles. So if people wish to make the adjustments, they can do.
Cool. Thanks very much.
Thank you.
Our next question is from George O'Connor of Stifel. Your line is now open. Please go ahead.
Good morning, and thank you very much for taking my questions. I appreciate your comments on there's more uncertainty in terms of year on year. My interest is really around the sequential progress, and specifically how it relates to your comments on procurement. So firstly, how has phasing played out? Has it sort of improved through the period, deteriorated, no change? In terms of procurement, is a matter of more hurdles being put through the procurement process, or are you seeing moratoriums? And then I appreciate it's a little bit of navel gazing at this juncture, but is there any issue at all around a bigger than expected budget flush period this year, simply as customers defer procurement until calendar year end? Thank you.
Thank you, George. Good morning. So let me see if I can say some words about phasing to start with. First of all, we've seen phasing vary according to our geographic regions. So I think, as I said before, we saw APAC hit first, then Europe, then America, and then they came out or improved also in that area. So we saw proposal volumes, which is one indicator that we track of demand, obviously, fall quite substantially in end of March, April time in the UK. We saw them recover a little bit coming back into May time and recover a bit further into June, but we haven't seen them spring all the way back up to the kind of levels they were at before. The US, we saw proposal levels lag that a little, but again, we saw them, depressed quite significantly in the final months of April and then into May, and they have recovered, again, but not to the same level as we would have seen pre-pandemic. So I suppose that's what we were trying to get across. Procurement, it's absolutely fair to say, as you asked the question, the answer that springs to mind most readily is that more people tend to be involved in each procurement process, which means that there just tend to be more people who have to say yes, more gates to go through, and therefore an inevitable lengthening. We do mention in the RNS that some of our clients in the leisure and entertainment sectors have, almost explicitly pushed stuff back about 12 months, because they just have far more urgent things to focus on. So in those sectors, we are seeing, if I understand the term correctly, perhaps that bit of a budget flush where people are pushing everything they can, out. But that's not true of every sector. And I would point to some of the tech sectors and some of the banks as not behaving in that way as far as we can see.
Great stuff. Many thanks.
That's all. Thank you, George.
Our next question is from Julian Yates of Investec. Your line is now open. Please go ahead.
Yes. Hi both. Can you hear me?
We can indeed. Good morning, Julian.
Great. Thanks. Just a couple of questions on the differing portions of your risk management consulting business and the MDR piece. It'd be great if you could talk for a couple of minutes about sort of both. I guess sort of firstly within the risk management bit, I guess it's one of the few areas of the statement where it seems to have come below expectations. Everything else has done very, very well relative. Could you maybe talk a little bit about why that is continuing to have sort of troubles in terms of finding its footing, its strategic footing? and what the business is doing to address it. You mentioned a little bit in the statement, but it'd be good to know a bit more about that. And financially, has that been a drag in terms of low utilization on the profit numbers? And if so, could that actually act as a positive swing if that stabilizes and you look to, I guess, improve the financials there? And contrasting on the MDR side, that seems to have really sort of taken off very, very well. I guess the question is, so what are you doing right on the MDR side that maybe is not happening on the risk management piece? And how do you see both divisions over the medium to longer term? MDR, are you looking for that material growth ahead? So a much bigger division, and risk management may be stable to flat, just maybe a medium term picture as well.
Yeah, absolutely. Let's see if I can get to those. So let's talk risk management first. And let me preview my answer by saying, under the banner of risk management, we've got a variety of things, advising people on process, on policy, auditing, compliance, for example. And so there are pockets of our risk management team which have been very, very strong. Areas like PCI compliance, often the more technical areas, if you like, are where we are sought after, where it plays very strongly to our brand, and we've had pockets of people working incredibly hard. That's true. It is an absolute frustration for me that over the last couple of years, risk management has declined ever since the high watermark of, let's call it, the GDPR days. And I think if I'm going to wash our laundry reasonably publicly, I would say, when we had those halcyon days of risk management, it was the end of a few years of really very explosive growth in risk management, where we've grown a business line from very, very little to really, something quite significant. And we started to branch out. We hired a lot of people. We went into broader risk management. And then as the bow wave of GDPR demand receded, we got ourselves into a bit of a negative cycle where we found there was less work to go around. It was more competitive in the market. Our brand didn't play quite so strongly to some of the more generic risk management. And of course, that's a very difficult cycle for our teams to get out of. And we've certainly been hit by that. I will say that, without pulling the COVID card, it is probably one of the more affected areas by the pandemic, because on the whole, our people need to be on client sites, interacting more directly, and some of that work does appear to be more discretionary in our clients' minds. So I'll point to a little bit of pandemic, but even without that, I'm afraid risk management was coming back. So we are absolutely determined to make a success of this, and so the future is about really drawing in our offerings to be closer to our technical expertise, closer to our brand. I will repeat something I've said for a number of years, which is there are many more business problems to do with cyber than there are technical problems. So I still believe that when we get this right, it will be a positive thing. I will flag that, yes, it has been a drag on Ute, and it's going to be a drag on Ute certainly through the first half here, because, as I say, it's been one of the more impacted areas. But we're very focused on getting that clearer, narrower proposition that links in with our technical strength. But happily, on the other side of the fence in MDR, you're right, it has taken off, and it's an absolute delight. And I would point to the work that a number of our teams have done. I'm just going to say this very straightforwardly, working out how to sell it, Julian. Because NCC has built over the years this team which is fantastic at selling technical security consulting. And then a few years ago, when this managed services proposition came along, that team didn't really know how to sell it. So the work that we've done to clarify that proposition, to educate the sales team, to put in place pre-sales expertise that can help scope work with clients to put the right package together, I would say is what's behind part of the success. And the other part of the success, because it's an absolute delight to me that we can win this work off much bigger firms, who have many more research dollars to spend. I think it's our focus on cyber and our understanding of the space and our agility from being a little bit small, which is what attracted clients to us.
And sort of taking that one step further, if we look out to the medium to longer term, it feels like that sort of commentary on MDR seems sustainable. It seems you have quite big ambitions for that business with this sort of renewed sales vigor. How should we look at the risk management consulting business sort of medium to longer term? Should we see that as just sort of holding its ground, or are you still committed to sort of growing that business quite materially once, I guess, the sales proposition has been narrowed to meet your areas of expertise?
Yeah, I think once we're through whatever uncertainty that we are facing at the moment because of COVID-19, I see no reason why it cannot grow at TSC-like rates, okay, technical security rates. So we see the overall professional services proposition as being able to grow at the same rate.
That makes you concerned that your risk management consulting business is facing structural issues within its position in the marketplace. It's more you just need to tune it to what's out there better.
Yeah, I'm not concerned that we're facing structural issues which will prevent us from being able to grow. I think that we have to be mindful going forward to ensure that what we sell plays to our brand, or that we extend our brand in a measured way. But again, I will stand by the fact that many of the challenges our clients face in cyber, yes, they have a technical component to them, but they also have a rounded business risk component, which requires at least as much work and at least as much intervention. So, I'm perfectly comfortable with risk management in the medium term.
Yep, and congrats on the results. Thank you.
Thank you. Appreciate that.
Our next question is from Damindu Jawaiwa from Peel Hunt. Your line is now open. Please go ahead.
Hi. Just had a couple of questions. Well done on a great year. The first one is more around on the marketing side. So you've kind of rebranded, you've changed some names. For example, Fox IT, you are now calling, I think, NCC Europe. It's great to see, like the Zoom CEO mentioned NCC on a blog post. It's also great to see you guys being mentioned on articles around open source security alongside the names like Microsoft and Google. And I was also impressed by the Fortune 500 customer gains. Do you feel NCC is now, as a brand and as a company, is now more visible than, let's say, just a year ago? Or has nothing really changed in terms of visibility?
Hi, good morning, Damindu, and nice to hear from you, actually. So there's just one thing, one sort of little point there which I have to correct. It's our Danish operation, which has legs in a number of parts of Europe, originally called Fort Consult, which has been rebranded NCC Europe. So Fox IT still remains and is called the same. It is an enormously powerful brand in its home market. But to your broader point, we've done more work on marketing in the last 12 months than we've ever done before. So I do hope we are a little bit more visible than we have been. And part of that is just the whole one firm, one way mentality that underpins our transformation program starting to come good. Whereas historically we've had 5 different marketing departments all plowing their own furrow, never the twain shall meet. Now, thanks to, and look, don't tell him, the efforts of somebody in our firm to bring these teams together to divvy up tasks, not on a sort of regional basis, but on a functional basis, we're starting to have more and more impact. And in fact, I think that's going to be accelerating over the course of the next 12 months. We're also taking strides, Damindu, just to articulate ourselves better. Again, you've got to remember that NCC comes from a background of acquisition and has been enormously fragmented in the way that it operates, in the way that it expresses itself in the market. Whereas, although different territories require something a little bit different, on the whole, the cyber problem is global. The cyber problem is the same, the world over. And so we're making great strides to be able to articulate our portfolio in the same way wherever we are in the world, which I think is just getting better traction. It allows us to spend every marketing dollar, once for the benefit of the whole group rather than split it into 5 firms. And, the teams have done a really good job of working with clients when they do high impact work, doing better at getting the odd cred and qual that we can mention. So it's nice to be able to show off a bit.
And Adam, given where your attrition was in FY20 and a better outlook for demand, can you make some comments around where you see wage inflation and kind of the attrition trending? Because I've heard, obviously, you are starting to hear your competitors are, ramping up their own hiring as well as they kind of start to see 2021 being a good year in general. You're happy with your kind of wage inflation and attrition outlook for the time being?
Yes, I think that's a really important topic, and I think for every competitor that is ramping up hiring and thinking about increasing wages, there are competitors who are doing exactly the reverse. So I would observe that a number of our competitors are deeply underutilized, as evidenced by some of the day rates that they are pitching against us from time to time. So I do think it's a mix. For our part, we have been quite cautious on pay. We've asked our colleagues. We postponed our pay round, for example, from earlier in the year, and we will make more decisions in the month to come as to whether we'll be doing anything significant on pay or not. But again, we'll just see how the world evolves. But we are very mindful, right, that at the end of the day, we have to retain the people that we need to continue to have a distinctive NCC and a distinctive capability. And it's also fair to say that this is still a high demand environment. So whilst attrition has naturally slowed a little because of greater job uncertainty in the times of COVID, we have still seen a gentle flow of people heading off to tremendous jobs in our client base. And as always, we shake them by the hand and make sure we turn them into a customer. So it's a balancing act from Indu that we're going to have to continue.
And just kind of going on the comment that you made about competitors who are underutilized. So during times like these, you obviously get crazy day rates here and there. What's the strategy you are employing? You are basically holding tight on your pricing because of the quality of the offer rather than, is there kind of I'm trying to figure out if the pricing is under pressure in the market in general, or is there just pockets of crazy pricing and the kind of the ones who are doing well like yourself are just not trying to outbid those crazy prices?
Yeah, it's a mix. I mean, we have no interest in engaging in a race to the bottom, and we won't. So in the UK, I think we've seen day rates hold up as our teams have successfully managed to sell the value. If we're looking at some day rate pressure from some of our larger clients, we'll be looking for volume commitments so that we can maintain a high utilization and get the same kind of realization off the back of it. So, that's what we're seeing. And I would say that whenever we've seen this before with people cutting prices because of underutilization, it's something that doesn't last for long. They can't keep it up.
And on just lastly, I may have missed this because you did comment on MDR. I know that MDR is being rolled out into the US. I guess it's fairly early days. I mean, what should we expect? I mean, would that actually grow fairly rapidly, or is that going to take some time to ramp up in the US in the way that it has a very strong hold in Europe? I mean, the US is not going to be the biggest market overnight for you, I assume.
No, it's really early days for us rolling out MDR in the US. So, we've had a couple of nice little early wins that we're really, really pleased about. But actually, Damindu, I think we're just not going to talk about it. We're just going to get some nice track record under our belt, get a sense of what the growth rate's going to be and how far we can drive it, and then we'll probably come and shout a little louder about it.
Yeah. And lastly, what I wanted to the extent you can, what I wanted to understand was the Q1. Obviously, you mentioned it has grown year over year, and we know that it had a easy comp. But also there was that M&A activity, which is at a heightened level. And I assume that M&A activity actually continues for some time, given by the news flow out there and the cash piles that most of these tech companies have. But is it possible for you to give some comments around what it looks like, what Q1 looks like if you didn't have that M&A activity, heightened M&A activity? Is it kind of down year over year, flat year over year? Only if you have the data.
Yeah, I mean, I think it's hard to say, because I never know. I know some stuff that's obvious to strip out, and then you never know quite which bits to strip out and what bits to add in. So, roughly, who knows? Flat, I guess, would be an estimate. But I got to say, I don't really have the data to give you an accurate answer.
And just lastly, I know that you kind of talked about visibility being still lower versus last Q1 into Q2, for example. But your tone in the release, in what you are saying, in what I can see on LinkedIn from your employees and so on, there is a certain level of let's say return of confidence. Obviously, I remember talking to you back in March, April time, and it felt like the world was ending. And then there is this surprise in kind of June, July, or May, June, July level when things are kind of starting to pick up. And now there is a sense of confidence returning. Am I reading too much into it? Or are you actually genuinely surprised by how quickly things are kind of picking up, although they haven't got back to normal? But are you genuinely surprised by how quickly things have turned around?
I think it's partly being surprised about how things have turned around. I mean, but actually I'm also just impressed by how well some of my colleagues have demonstrated resilience. Because, back in March when we didn't know how the world was going to pan out, we developed several contingency plans, some of which were quite extreme, because if the world really did fall off a cliff, we were going to have to enact much more vigorous things. But number one, demand held up. Number two, we moved to remote working completely seamlessly and also rolled out ways of operating remotely with all of our clients. And third, we sold. We really went out and sold. So where my confidence comes from, and where the confidence that you see oozing through our statement comes from, is that I believe in the resilience of NCC far more than I did 6 to 12 months ago, because I think that we've proven it. And resilience is just the ability to cope with whatever comes at you, even when you don't know what it's going to be. So, we have better data today. We have a wonderful management team which is highly motivated, demonstrating itself to be very competent. I've been privileged to see a response from our workforce, which, on the whole, has absolutely, mucked in to try and get NCC through this, and that's what gives me confidence. We may collectively hit some stumbles and bumps as the economy goes up and down, and we deal with whatever this winter has to throw at us. But where we are confident to pay the dividends and to give you the sentiment that we're giving you is because I think we'll cope with it.
Thank you, and thanks for a job well done, Adam. Well done.
No, thank you, Dimitri. Appreciate that.
Our final question is from Caspar Erskine of N+1 Singer. Your line is now open. Please go ahead.
Hi there. Hi, Adam. Hi, Tim. Thanks for the opportunity and also a great set of results. I just had a few very short questions. One was on, you mentioned a compliance deficit in your RNS earlier. I was just wondering whether this is largely being driven by digital transformation, adding additional need incremental to what was there before, or is this largely the 15 million pipeline that or revenue impact that's been pushed out coming back as pipeline in the longer term? The next one was on utility rates. I was just wondering how those the reduced utility rates being taken advantage of, whether you're pushing staff into more R&D development, or whether you're beginning to take the opportunity to potentially look at some smaller deals that you might not have looked at previously, as I think average order sizes continue to tick up. And the final one was just if you've got any data on exposure to COVID-19 impacted sectors, that would be brilliant. Thanks.
Lovely. Well, look, I'll comment on the first couple, and then maybe I can hand over to you, Tim, to round us off on exposure to impacted sectors. So, I mean, the views about compliance debt, I wouldn't necessarily link it directly to the £15 million. That's been delayed or deferred. I think it is a comment on the behaviour we see all around. And so again, if I take some of our clients in the entertainment and leisure sectors, there's no doubt they've taken on more systems, that remote working is more prevalent, that actors are doing bad things even more vigorously than they were before the pandemic arrived. But they have other things on their mind. They're far more worried about their business model, whether they can turn a profit, whether they can generate cash, and so they had chosen to prioritize spending in certain areas, and they had chosen deliberately not to spend on cyber. And that's no surprise, right? We've all known that if you didn't have to spend on cyber, then you wouldn't, right? But you do. And the four secular drivers I talked to earlier means that we all have to spend more and more money on cyber. Otherwise, we're going to get caught out. And so therefore, in the round, there is this well of compliance debt that's picking up. And when things normalize, people will get back to sorting that out, and it'll drive a better ways of work. On the util side, the util is down, as you would have seen in the presentation numbers. Our large average order values are significantly driven by the increase in MDR orders, which tend to be multi-year. So that's part of what's driving our increase. We still do a lot of, 10 to 20,000 pound engagements across the patch for SMEs. So I'd say, actually, we're not too snobbish about still continuing to do all of that work. We think it's important work, candidly. So we're still heading for the small stuff. And Tim, finally, do you want to say anything about how you see our exposure to some of the more impacted sectors?
Sure. Hi, Casper.
Hi.
So, if we, as Alan mentioned before, we saw the pandemic as it came across the geographies. So we actually picked it up in January out in Asia Pac. By February, we were realizing it was a thing. And in March, we did an assessment of the sectors that were likely to be impacted, which unfortunately turned out to be true, which is leisure, travel, and retail, and anything to do with consumers. When we ran the rulebook across our whole global customer profile, we found that there was only about 16 to 17% of our sales pipeline was exposed to those, what I would call, unfortunately, distressed sectors. And so we were pretty well isolated because we tend to deal with, obviously, large companies, large corporates, blue chips, TMTs, financial services, those sort of sectors that have been less affected by COVID. So from that point of view, our customer set helped us in our resilience as well.
Brilliant. Thanks so much, guys, and congratulations again.
No, thank you, Casper.
We have no further questions, so I will pass back to you, Adam.
That's lovely. Well, look, thank you very much, everybody, for attending. Really appreciate it. I hope we've been some help in those questions. And, we're looking forward to seeing you again at our half-year results after we've, I hope, continued to make the kind of progress that you've seen over the last 12 months. And I'm sure we will all know a little bit more then about how things are faring. So with that, thank you very much again.